Okay. Can everyone hear me?
Yes, we can hear you.
Cool. I just want to make sure that this thing is recording. It is. Okay. All right. Cool, guys. So feedback on paper 2. What did we think?
It was okay.
I thought it was
So what was that?
I thought it was okay.
I thought it was okay. Not too bad.
Okay. Okay.
Yeah.
All right.
Daniel,
Cool.
can I just say something?
Sure.
So I also thought it was okay. I just struggle with application, like how to apply and when to apply what. Like I know what needs to go in, but I just struggle to like get the puzzle pieces in order. You know what I mean?
Yeah, yeah. Okay.
Yeah.
All right. No, that's cool. Let's run through the question quickly, and then hopefully we can put a lot of those issues to bed. Okay, so let's go into part A of the required. So, okay, so it says, with reference to hoi polloi dentists, identify, okay, and discuss the performance obligations of the dental units and other contract additions, okay, in terms of IFRS 15. Okay, so here, yeah, so the focus of the discussion is pretty much around the performance obligations. Okay, so just recapping some of the theory that we have around there. What do we know about performance obligations? What's the most important thing that we're trying to do when we're looking for performance obligations?
Must be distinct.
It must be distinct. And how do we determine if they're distinct?
So the IFRS says that the customer should be able to benefit from the good or service,
Okay.
either on its own or together with other resources that are readily available
To that customer. Okay, then what else? What else helps us to determine if the performance obligation is distinct?
Separately identifiable.
Separately identifiable. Okay, what else? In the case where these goods or services are highly interrelated, I'm sure you would have seen that when you work through your slides or your standards. Sound familiar?
Yes.
Okay. All right. So pretty much, guys, the focus of the discussion is pretty much on distinct performance obligations. So let's now go through the question and let's see what they have to say. All right, cool. So they pretty much, let's start at the top. Okay, so hoi polloi is listed on the JSE. It's a manufacturer of dental units and a wholesaler of various hygiene products. A dental unit includes a chair, an instrument tray, and an LED light operation. So under normal circumstances, we'd say performance obligation 1, performance obligation 2, performance obligation 3. But then they go on and they say that these items cannot be purchased separately. Okay, so the fact that they cannot be purchased separately, what does it mean from a performance obligation point of view? They're not separately identifiable. All three of them together make one performance obligation. Happy?
Yes.
Yeah.
Okay. All right. Dental units and other contract additions. Okay, so they say the terms of the contract terms and conditions relating to the sales of dental units are as follows. The contract gives you a 30-day 100% money back guarantee. Is that a performance obligation?
No.
Why not?
Because I feel like it's dependent on you buying dental unit. You
Okay.
can't have a guarantee if you don't have.
Yeah.
Okay, so we agree that it is a performance obligation because we have an obligation. In the case of somebody brings it back, we have to return the money, right? So it is an obligation,
Yes.
but it's not a distinct obligation because it
Yeah.
doesn't stand separately of the unit. Okay, so
Yes.
it's not like somebody will walk into the store and be like, "Hey, can I get one of those 100% money back guarantees?" You know what I mean?
Yeah.
Okay.
Yeah.
All right, so it is an obligation, but it isn't distinct. All right, during the past 3 years, 3.3% of all dental units have been returned within the 30-day period. Okay, that's cool. That means nothing to us for now because we know it's not distinct. So then this obligation will then be part of the sale of the unit, this first performance obligation that we've identified. Okay. Next part, they then tell us included in the contract is a 1-year warranty, which covers the full replacement of any unit that doesn't work well. It assures the customers that it will comply with agreed upon specifications for a period of 1 year from the date of purchase. Okay, is it a performance obligation?
Yes.
It is a performance obligation, but is it distinct?
Yes.
No.
Not distinct. Why?
No. It can't be sold separately.
Yes. That's what it says.
Okay, so they go on to tell you that it cannot be sold separately. Okay, but do they need to tell you that? Again, no, because nobody's going to walk into the shop and say, "Hey, can I get one of those warranties, please?" It comes with the underlying item. Without the item, the warranty is actually useless. Okay.
Yeah.
They tell us that the estimated cost of the warranty is 15,000, and during the past 5 years, 6% of the units have a required replacement. Okay, that's cool. Then the last part is they tell us that the contract provides the customer with the right to receive training services. Is that a performance obligation?
Yes.
Yes. Okay, because we have an
Yes,
obligation to
but-
render those services as part of this contract. Okay, is it distinct?
Yeah.
Yeah.
Yes. Why is it distinct?
Yes, it is distinct.
Why is
Because
it
it's
distinct?
sold separately.
Okay,
It's
so
sold separately.
we get told here that they sell the training services separately. And also, can the customer, in the case where the customer didn't have this dental unit, they had another dental unit, but they required some training and stuff, could they come do that?
Yes.
Okay, so the
Yes,
customer
they
also has the
can.
option to purchase these training services separately. So is this distinct?
Yes.
Yes.
Yes,
Yes,
yes.
that
Because
makes
the customer
performance
can
obligation
be
number
on-
2. Okay.
Mm-hmm.
All right. So I mean, I think at the end, it was pretty much just outlining the principles around distinct performance obligations. So even if you go check the solution, I know that it looks like it's a lot of marks, but you'll see a lot of the stuff that we've discussed already is pretty much sitting on the solution. Okay. One of the things I want to point out to you guys, you see this whole first bit here on the solution, this whole section here, which is pretty much a spit out from the standard. How long do you think it would take you to write this out in an exam?
not too long.
Let's say 3-4 minutes maybe, if you're going to copy it out of your standard.
No.
Okay, let's say even 2 minutes. Either
Yeah,
way, guys,
2
the point I'm trying to get to you is they gave you half a mark for writing all of this out.
Oh.
So what I'm trying to get across to you guys is don't waste your time copying out theory from the standard. I would summarize this as briefly as you possibly can. So within 30-40 seconds, you have it down and it's written, because all the other marks are actually awarded for application, okay, which we'll get to now. All right, so let's have a look at the application. The dental unit as a whole is capable of being distinct. Okay, we concluded that, okay, because a customer can benefit from using it without the warranty or the training services. Okay, we agreed that that was the case, right? 1 mark. Okay.
Yeah.
It's also separately identifiable because it's not highly dependent or highly interrelated with other goods or services. So in the case where we buy, so we spoke a little bit earlier when we looked at the overarching principles of distinct performance obligations. We looked at, we spoke about the principle of things being highly interrelated. Now, because this is a standalone unit, you don't need to install this thing with other pieces of equipment in your dental practice. It means that the customer can use this by itself, okay, without any other assets that the customer has. All right. It's not specifically modified or customized. Okay, so it's not like we do something special per dentist. The unit is sold as it currently is, and we do not provide a service to integrate this dental unit with any other items in the dentist's practice. Okay, so these are all the half marks that you would get for application. So then you make a conclusion that the dental unit is distinct. Yes.
Sorry, your solution's not up on the screen here.
Oh, sure, but sorry. Thanks for letting me know now.
Sorry.
Share screen. Okay, here we go. Okay, so pretty much just to recap, this half mark part is the part. So you see, I mean, you're going to write out all of this for half a mark. Can you see it now?
Yes.
Yeah, we can.
Yeah. Okay. So this is the one where I'm like, guys, just think very smartly about how you're going to earn this half a mark. Just sit and write this out. I think it actually takes longer than what you think. So summarize this in your standard and have a standard, sets of wordings that the market can see that you are using keywords. That means you're applying this to be able to get this half mark. But to spend even more than a minute trying to write this out is a waste of time. Okay. All right, so the units being separately identifiable. Okay, so we had covered all of these principles. So then again, guys, there is a mark for a conclusion. So you've identified a performance obligation. We're then discussing in this part here whether the performance obligation is distinct or not. And then there's a conclusion mark to say, what are we deciding at the end? So we said the dental unit is a distinct performance obligation. Happy. 30-day money-back guarantee. When we spoke about this, we said it's not a performance obligation because it doesn't stand on its own. Okay, so it's a function of the underlying product. 2 marks. 1-year warranty, the exact same thing. Okay, one of the things I've seen this come up in this for the second time now. I know you guys haven't covered IS 37. But what I would suggest is when we're looking at these warranties, we said it is an obligation of the company, and those obligations are governed by IS 37. And it's so far the second solution that I've come across where IS 37, whenever they have these warranties, that they raise IS 37 on your solution. So from an exam point of view, guys, if they ask you this in test 2, and you see a warranty coming up in a revenue question, just make the comments about IS 37 to get those 2 marks. Okay, I know we'll cover it later on in the year, but I think they're assuming that you have enough knowledge from your undergrad to at least identify that. Okay. All right. So again, the 1 year of free warranty gives you assurance that it will that you'll repair or replace the machine in the case where it's not functioning. All right, you do not have the option to purchase it separately. Okay, we made that comment already. And it doesn't provide you with the service in addition to the dental unit. Yeah, so therefore we conclude it is not a performance obligation. Again, another 1 mark. So guys, can you see the exam technique here? We start off by discussing whether you have a performance obligation. Then you go on to discuss whether the performance obligation is distinct or not, and then you conclude whether it's a distinct performance obligation. Okay, So can you see it's just on having good exam technique and concluding on the 2 performance obligations, there's already been 2 marks up for grab. So it was this one and the other one on the first performance obligation. Okay. And then this was the little sneaky that I mentioned to you guys, where if you have a warranty provision, we deal with this in IS 37. And I don't think you need to go into too much more detail than that to get your 1 mark. And so because of that, your money back guarantee should be, and your warranty should be bundled together with the sale of the dental unit, which is what we discussed as well. So because they're not individual performance obligations, we lump them all together with the sale of the unit. Happy?
Mm-hmm.
Okay. The training services, okay, so the training services we said are capable of being distinct because the customer can benefit from it on its own. We spoke about that. They are sold separately, all right? And it's not integrated with the dental unit itself. So you could either sell the dental unit by itself, or you could sell training services by themselves, or you could sell the 2 together. All right. Again, the training services are not significantly modified or customized per dental unit, and so they are not highly dependent. And because of that, we then conclude that it is a separate performance obligation. Again, exam technique. This is the 3rd mark that we see on the solution for concluding. Okay. And then once we've concluded on the various performance obligation, there's then a 4th mark overall for concluding overall, just to then wrap up your discussion and say, okay, from the end, we have 2 performance obligations that we've identified. And in the case where you write nicely, you get 5 marks. So can you see from an exam technique point of view, guys, there's 5 marks available, 4 for concluding, 1 for your communication and logic out of 12. So can you see you're already more than halfway to a pass just on having good exam technique? Okay, so guys, revenue is one of the things I can guarantee you, and test 2, it's going to be there, and it's at least going to be 30, maybe even more, 35 marks out of your 40. So it's absolutely crucial, guys, that you're comfortable with it. I mean, if I look at the past year's board exams, in the past 4 years, revenue has come up in ITC every single year, including this year in January 2020. Revenue was in the ITC paper. So it is the type of thing, guys, it's hell of a topical. What I will do is I will put up some more questions on the PACER ITC questions. You need to make sure you work through all your TUT letters and get as comfortable as you can with revenue ahead of test 2. It is hell of a topical, and I guarantee you it won't be less than 30 marks of test 2. So this topic alone will decide whether you pass or fail. Okay, let's go look then at part B. Stop share. Okay, so part B of the requires us to prepare the journal entries, okay, to account for the customer loyalty program in the financial statements of hoi polloi, and they only want this for February 2019. Now, how many of you felt comfortable with this part of the required?
It was tricky because they put 2019's amount first and then 2018's. I got confused into the wrong amount.
100%. So I pretty much I had the same feedback as you guys. I got a little bit confused, and then I had to go back and reread and make sure my timeline was plotted properly. So in this particular question, the information was slotted a little bit funny. But either way, a timeline is obviously hell of a useful for something like this. So set one up here at the bottom. And as we go through, I'm going to be plotting the information in just to keep our head above water with all this information. Okay. So let's have a look at this customer loyalty program. So we said during the financial year ended 28 Feb 2019, which is the period that they've asked us to journalize for. They said we sold hygiene products for a standalone price of 13.75 million. In March 2017, we started this customer loyalty program. We started this customer loyalty program where we would issue 1 point for every 250 Rand spent, okay? And each point has a standalone price of 5.50 Rand, and people can redeem these points against future purchases. Okay, so far not so bad. Then we expect, they tell us then we expect 35,000 points to be redeemed cumulatively, okay, for the revenue earned in the financial year 2018. So now this is where the information starts getting a little bit muddled and difficult to follow. So if we look at the information, the timeline that I've set up below, all right. So they've given us the revenue figure. So we've got 2018 and 2019. Okay, they've given us the revenue figure for 2019, and they've also told us that we expect for 2018. So let me make that yellow. They expect for 2018 that 35,000 points will be redeemed. So that's pretty much here. This 35,000 points that they're talking about are relating to 2018 sales. At the end of 2018, we had only redeemed 22,000, okay, that were redeemed by its customers. And then at the end of 2019, we had 34,850 that had been redeemed in respect of 2018 sales. So again, mind blown, information all over the place. Nobody knows what's going on. And then in addition to that, they tell you in respect of 2018 sales, we still expect that 35,000 will be redeemed. Okay. So to put this information in easier terms, okay, pretty much what they're saying here is that we expected 35,000 in total from 2018 sales. In 2018 itself, we redeemed 22,500 in total. In 2019 in total, we redeemed 34,850. So that gives us how many actually redeemed in 2019? How many is that, guys?
Is it 12,420?
12,220. 12,270. Okay.
Oh, 12.
So 12,270. So they've told us, as at the end of 2019, we've actually redeemed 34,850. At the beginning of the year, we had redeemed 22,580. So the difference of what we've redeemed in the current year is 12,270.
Oh.
Okay. So just going back down
Okay.
to my timeline. Okay. All right. So we expect 35,000 in total. In total, we only have 34,850. And that 34,850 is broken down into three categories. So in 2018, we redeemed 22,580. In 2019 was 12,270. And at 20 in the future, we are still owing 150. And the 150 is effectively the difference between what we have redeemed and what we expect to redeem. So it's a 34,850 and the 35,000. Everyone comfortable with where these numbers are coming from?
Yeah.
Okay. I'm just putting the solution in a little bit of a different format as well, because I found the solution quite difficult to follow, the train of thought. So I've set it up like this. Hopefully you guys will find it a little bit easier to manage. Okay. All right. And then they tell us that total sales for 2018 amounted to 800,500 Rand, 10,800,500 Rand. Okay. So we go slot that as well on our timeline. Okay. Oh, there's a typo there. There should be 500. So guys, just correct this number here. It should be 5, not 0. Okay. So that's what they've given us there. All right. And then they tell us at the end of the 2019 financial year, 32,540 have been redeemed by customers. 32,540 have been redeemed by customers, and we expect that 38,000 will be redeemed in total in respect of 2019 sales. So go slotting that into our timeline. So for 2019, they're saying we expect to redeem 38,000. So let me just use the right colors. We expect to redeem 38,000, but we've actually only redeemed 32,540.
Mm-hmm.
Okay. Right, that's all cool. And then they tell you that the accountant has correctly processed the following journal entry, and they give you all of this stuff. Okay. So again, not much that we can do with that because it's already correctly done. And they've also asked us to process the journals per the required for 2019. So 2018 has been taken care of. So we just need to do 2019. Okay. Now let's go look at these calculations quickly. All right. So we know that for every 250 Rand spent, you get 1 point, right? So if we want to calculate the number of points that we have, we just take the amount of revenue divided by 250. Divided by 250. So that gives you 43,202 points. Sorry, there's also a typo there. Just make it 202. See if I can do it quickly. This is 202 points. Okay. And in 2019, we issued 55,000 points. Yeah. So we need to calculate those points numbers because we need to calculate what is going to be our revenue split, right? Okay, because we treat a customer loyalty program like a separate performance obligation. All right. So if you look down at these calculations here at the bottom, I've done the split for you. So for 2018, we have the goods of 10.8 million, which is what they gave us. And then we've got the value of the points. Now, how did I get that value of the points? It's the 43,020 or 202, 43,202 times multiplied by what, guys?
You have to multiply by the standalone selling price.
Careful. So what is the standalone selling price for the points? I'm just going to put a little star here so we can repeat this calculation at the bottom. So if we have 43,202 points, and we know that each point is worth 5.50 Rand, that's how we get this 237,111. Everyone happy?
Yeah.
Yeah. All right. So in total, our revenue is this 11 million. Okay, 11,038,111. And now we know that we need to allocate that transaction price to the various performance obligations. Okay. So in other words, you go 850 divided by the 11 times by the 10, and then 230,000 divided by the 11 times the 230,000, and it should give you these numbers. So this is all mathematical exercises. Is everyone able to get those?
Yeah.
Okay. So can you see pretty much what we're saying is the total here. Okay, so pretty much what we're saying is the total revenue per the contract is 10, 800, 500. Okay, and all we've done is we've allocated that to the performance obligations. So can you see the 232,496 is the performance obligation for the points? Everyone happy with that? That's how much revenue we expect to get from the points. And how many points are we expecting to redeem? 35,000, right?
22,580. Oh, expected is 35.
Yeah, we expect 35. So if we take this 232,496 and we divide it by the 35,000, it gives us a value per point of R6.64.
Yeah.
Okay. So if we want to calculate our revenue, okay, and we know that each point is worth R6.64. So in this year, if we had 12,270 points, 12,270 times 6.64, what is our revenue? 81,473. Because remember, we're doing these journals over the 2019 year.
Okay. 81,506.
Okay, there would be a small rounding difference because the 6.64 is probably 6.6381 something. So there will be a small rounding difference. Right? I'm just trying to get the principle over to you guys. Okay.
All right.
And this 150, what is this 150?
Unredeemed.
It's unredeemed. So we're still owing that 150, right?
Yeah.
So we'd expect to see an obligation in the accounts for these 150. Because when somebody comes to redeem it in future, we owe them stuff, right?
Yeah.
Okay. That's pretty much the 2018 points. Let's look at 2019. It's the exact same principle. Okay. So out of the 55,000 points, each point is worth how much?
The
The question told you?
I think it's also 550.
Yeah, that's right. R5.50. So 55,000 points times R5.50 gives you 302,500. Everyone's happy with how we got that? How we got this number?
Yeah.
Okay.
Yes.
All right. And then we do the same apportionment calculation where we apportion the 13.8. So my writing has just moved over a little bit. Okay. So that's the total transaction price. So what we do is we allocate that transaction price to get it to this 13,750. Okay. So is everyone able to get those allocations? Exact same principle that we did just now.
The 14, is that just the 13 plus the 2?
What 14?
14. Oh, are we looking at the 13,750 now?
Yeah, it's the 13,750
Okay, yeah.
and the 302 for the points. That gives you a total transaction value of 14 million, but we need to allocate the transaction price to the components. So that's where we're getting, yeah, if that makes sense. So are you able to get these allocations here?
Yes.
Okay. Now, the 295 again is the value of the points, right?
Mm-hmm.
How many points do we expect to redeem?
38.
38,000. Okay, so if we divide it, it gives us then 295,988 divided by 38,000. Okay, I've got 7.79, but there'll be a small rounding difference there too. Everyone able to get that?
Yes.
Yeah. All right. So in the case where we're looking at the actual points that were redeemed in the current year, okay, the question has told us that we redeemed 32,540. So times 7.79. That gives us a 253,459. Okay, everyone follow where these numbers are coming from?
Yeah.
Yeah. Now with that said and done,
This is redeemed.
Yeah, these are the redeemed, and then obviously there's a portion of unredeemed at the end of the year. So to calculate those, we would say it is the 38,000 less the 32,540, which will be 5,460, and those will also have a value of 7.79, and that will give you a number 42,533.
Yeah.
Okay. All right, guys, just bear in mind that my numbers here will be slightly off because of rounding, but as long as you're getting the principle on how to calculate these things, let's go have a look and see what they've done on the solution. Yeah. All right. So not a hell of a lot going on the solution, but the first calculation they have is the contract liability. So in other words, these are 2018 points that are redeemed in 2019. So remember, we said when we calculated the value of those 2018 points. It's roughly 664. Remember that?
Manuel, there is a breakdown of this on page 74.
74. Hold on.
Yeah, it gives you the
right
C1 calculation.
Yeah. Yeah. All right, cool. Yeah, see, the thing is on this calculation, they don't really do it on a value per point. So it's a little bit on this solution, it's a little bit difficult to follow. But the principle is pretty much the same. So we're saying, so if you look here at this part of the calculation, in February 2019, there was the 2018 sales. So here we had said that there were 12 to 70 points that we redeemed from last year and this year. And those had a value of 6.64.
Okay.
Okay. So again, there's a little bit of a rounding difference, but that's effectively how they get that number. Okay. If you're able to understand this formula and it makes sense to you, that's also fine. I just feel like it's simpler to do it this way. And there's an alternative.
Sorry, Manuel, what is your way of doing it?
So you see this whole formula. I've just calculated to say based on our workings that we did on the question on the timeline, we said that there was 12 to 70 points that were redeemed in the current year, and each point was worth R6.64 that we calculated.
Yeah. Okay.
Okay.
Yeah.
So I suppose this is then a third alternative to what they're giving you in the question, but you get the same answer. Of course, there's a bit of a rounding issue here on the R6.64. Happy? Okay. So that pretty much is the contract liability, because that's the liability that we would have had. And that, remember that in the question, they gave you the journal entry that the accountant had done. And the accountant had a liability of, I don't want to switch screens. Can somebody tell me what entry the accountant had processed?
So it was bank 10, 800, 500 debit bank.
Yeah.
And then revenue for products was 10, 568,004.
Yeah.
Revenue for loyalty points was 149,993.
Yeah.
And then your contract liability was 82,503.
Okay. All right. So can you see last year, the contract liability was 82,503 from that question. And the solution is now saying that we have to take out 81,506. What is that leftover value? How much is it?
1 second. It's 997.
And what value, what is that?
That's unredeemed.
The unredeemed. So remember from our table here, from last year, we said that we were still owing 150 points at R6.64. Okay, we got 996. So that's our liability that's left from last year's allocations.
Sorry, Manuel, how did we get 664 again?
So that's this calculation down here, R6.64. So we said when we did the allocations, we said the points value was 232,496, and we expect 35,000 points to be redeemed.
Right.
So if you take the total value divided by the 35,000, it then gives you a value per point. I know it's different. It's different to the R5.50 that they give you, but remember the R5.50 is assuming that everyone redeems. Not everyone is going to redeem.
Yeah. Yeah.
Does that make sense?
Everyone. Yes, it does.
Okay. You might get a little bit confused by it, but I just feel like it's a little bit easier to understand than how the solution has been set out for now.
Yeah.
Okay. All right. So let's then go back to our solution. Okay. So we're all comfortable with what we've done there, and what is left in the account is what we are still owing, which is the 996 or 997. There's a rounding issue. Okay. Then for the current year, we received cash, so we're going to debit bank, right? That's easy. We have our revenue products that comes directly off our calculation that we did in our timeline. Everyone be able to reference that?
Yeah.
And then there's our points that we've allocated as well, also directly from the timeline. Okay, so there's the 253,459 and 42,533, which is then the remaining bits that we are still owing to our customers, the unredeemed portion. There we go. So can you see there we create a liability for that? Yes. Yes.
Sorry, I just wanted to ask, what do we do from the unredeemed points in 2019 for 2018's year? So if there's still something outstanding from 2018, how do you treat that?
Okay, so it all depends on what they give you in the question. So what happens more often than not is, like, for example, if you shop at Pick n Pay, your Smart Shopper points have an expiry date. Okay, so what will then happen is, once you hit that expiry date, you lose those 150 points that are left, and then that will be released automatically to revenue. So that 996 will then be released automatically to revenue. In this particular question, they specifically said that we still expect those remaining unredeemed points to be redeemed, and that's why we leave them in as a liability, because we're still expecting those people to come and redeem their stuff.
Oh. Okay. So, and there's no journal for that because we expect it.
Yes, yeah. And then when somebody comes and actually redeems it, then you release it from the liability into profit and loss or into revenue.
Okay.
Okay. Everyone comfortable with this?
Yeah.
Okay. There's an alternative journal that they've put you at the bottom, but you can literally, that's obviously just netting those two. In my mind, it's better to keep the two periods separately and journalize them separately. Otherwise, you're going to get yourself and the marker confused on what you've done. Okay, any questions on this, guys? Okay, so just to show you here, here in the question is where they said, where are we? Here we go.
Revenue is
So
on page 64.
This part here, where they say they still expect that the full 35,000 points will be redeemed in total. So in other words, that last 150 that hasn't been redeemed yet, we're expecting that it will still be redeemed.
Yeah.
If it wasn't the case and it lapsed, then you would release that 150 straight to revenue.
Yeah.
Yeah, it was a very good question.
So it'll be the debit contract liability, credit revenue.
Correct. Correct.
Okay.
Okay. All right. Let's then go on to the next part, C. Okay. Prepare the journal entries in the financial statements of Hoipoloi to account for the possible journal entries arising from the contract with SAR for the year ended 28 Feb 2019. Okay, so let's go have a look at this. Contract with SAR. Okay. SAR is a major dentist facility which provides dental units to the medical departments of universities. On the 15th of January, we entered into a contract with Hoipoloi and purchased 150 dental units at a standalone price of 85,000 Rand each. They manufacture these dental units at a cost price of 55,000, and the SAR has returned 2 dental units for a full refund within the 30-day period. What do we know about the policies of this company?
They do have a return policy. And,
they do have a return policy that you can get your money back within
30
days.
30 days. Okay. So when what is the standard policy? What do they normally provide for? The question tells you here that we normally get about 3.3% of all dental units that are returned.
Yeah, 3.3% have been
3.3% returned. Okay.
Yeah.
Let's go back to the question. All right. At 28th February, although being conditionally unentitled to the payment for the units, they haven't received any payments from them. Okay. So in other words, we just haven't been paid as of yet. All right. So let's go have a look at the solution. Okay. Now here there's alternative for this part of the question, there's alternative solutions as well. So you could do either the one or the other. Your numbers would also be slightly different depending on whether you looked at this from a units point of view. So the question told us that SAR had bought how many units from us? 150. Yes, no?
150, yeah.
150. And we say that we expect 3.3% of those units to come back within a month.
Yeah.
Yeah.
Okay. So there are, out of the 150, 3.3% is 5 units that we expect to get back. So if we look maybe at this second solution, let's start there. Okay. So we've sold units, 150 of them for 85,000 Rand. So we have a debtor. It's still sitting in debtor because the question tells you we haven't been paid. Everyone happy with that? Yeah.
Yeah.
And then we have revenue from the dental units. So we know that 5 of these dental units will be returned. Okay. So 85 times 5 units gives you the 425. And the rest is then revenue, your balancing figure. So for the 145 units, we record the revenue, which is 45 times 85,000 Rand. And that gives you this number here, the 12,325. Happy? Okay. The cost of sales needs to follow suit as well. So we know that the cost is 55,000 and we sold 150 of these items. So that gives us this 8,250. Yeah. We take 8,250 out of inventory. 145. So now because we've got 145 of them sitting in revenue, our cost of sales needs to match. So we then multiply 145 of these items by the cost to get the cost of sales figure. And what is the balancing of these last 5 units? This 275.
Asset right to recover.
Okay, so pretty much
Is that contract?
Yeah, so pretty much what we're saying is we're creating an account for an asset because we're expecting the assets to be returned. So we're expecting 3.3% of them to come back. So we've created an asset for that 3.3%, which is this 275.
Yeah.
Okay. Now the reason why we have to do that is because we have to match our cost of sales with the revenue. So revenue is 445 items. So cost of sales must also be 445 items. But out of inventory, we've taken out 150 items. Okay. So that was the provision that we made. And then that's those journal entries there. Then they tell us on the 15th, within 30 days, we actually did bring we brought back 2 of the items. Okay. So if 2 of the items are brought back, what happens with the other 3?
You recognize revenue.
You recognize the revenue. So for the 3 items that are not brought back, we have the revenue on those. Okay. For the 2 that were brought back, we reverse the debtor because they don't owe us the money for that, right? So that's for the 2 items.
Yeah.
Just put that there. So just make this a bit smaller. Okay, so that will be 85,000 Rand times 2 units. And your refund liability, so in other words, this liability that you've created here disappears. Okay, why? Because your 30 days is up. Let's link those 2 together. Okay, so we no longer have an obligation because our contract with you gives you the right to bring it back within 30 days. If you don't bring it back, it means we won't have to take it back. So that's how come we write it back. And then we do the same thing on the cost of sales side. Okay, the cost of sales side, we write back the asset because we're no longer going to get these items back. For the 2 that we have received, those go into revenue. Yes, that's for the 2. And for the 3, remember here we said matching. So here we released 3 into revenue. So we need to have the 3 into cost of sales to be able to match those 2 line items, revenue and cost of sales. Yeah. And then the last journal entry, guys, is what they told us, that we have a warranty obligation. Okay. And they said we expect that 6%. Because remember that warranty gives us, we warranty that if something goes wrong with any of those machines for 1 year, we will service those machines. And we provide, the question said that we provide for that at 6%. So 150 units times 6%. And they told us that the warranty value is 15,000. So that's how come we debit the expense of 135 and we credit a provision in SFP for 135,000. Yeah. So can you see a lot of the stuff that we did in inventory is actually putting through, I mean, half of the marks in the solution are all inventory related and releasing things to cost of sales and that type of thing. Okay. So if you go look at the first solution, guys, the reason why the numbers are slightly different there is because the 3.3% of 150 units gives you 4.9995 units. And that's how come these numbers are slightly different on this solution. But the principles are exactly the same. Yeah. And then the last journal being exactly the same, because that is just a warranty provision. Okay. Any questions on this part of the required, guys?
Yes. When do we use contract assets instead of debtors?
Okay, so contract assets, that's also a really good question. Let me get another page in here for you. So contract assets or contract liabilities, in the case, like, for example, we have construction contracts. So let me put in a little example here for you. Let's say, for example, the contract says, okay, so the contract is for 500 million. We're building a house, a mall, okay, for 500 million rand. And year one, we complete, let's say 20%. Year two, we complete in total 70%. In year three, we complete 95%. Okay, but the contract says that you are only able to invoice the following: year one, 30%, year two, 30%, and year three, 40%. Okay. So let's have a look at year one. All right. So from I'm just going to shift this example over so I can put a solution here on the side. Yeah. So from a revenue point of view, it's terrible. 18. Right. So from year one, revenue, what is our revenue value going to be?
30% of 500.
Careful. Remember, guys, when we account for these things, we always apply substance over form. Okay. So we have here, which is what is the reality on the ground? How much have we actually completed versus what the contract says you're allowed to invoice? Okay. So we always apply substance
100
over form. Okay. So year one, we then have a contract asset of 100 and we credit revenue of 100. Everyone know where I got those numbers from? So we're saying the contract value is 500 million. We've done 20% of the work in year one. So we should have revenue of 20%.
Okay.
Okay. Right. But the contract says that I am allowed to invoice 30%, which is how much? 150 credit contract assets. 150. So at the end, what does our contract sit at? Our contract sits at an overall liability of 150. Now, why is that? It's because I've invoiced you 30%, but I've only done 20% of the work. So actually, I owe you another 10% of work, and that's how come this thing overall sits at an overall liability. It's the net of those two. You don't have to do them in separate journal entries. You could do them in one journal entry. You get the same answer. Everyone comfortable?
Yeah.
Okay,
Yes.
let's just for the sake of completeness, let's do year two. Okay, so in year two, yeah. So we have so year two says we've done 70% in total. What's the value of that?
It's 350. No.
It's 350, but we've already accounted
Yeah.
for.
350.
We've already accounted for how much?
150.
No,
150.
100. Remember, in year one, we accounted for 20%
Oh, revenue.
revenue.
Yeah.
Okay, so
100.
we've already accounted for 100, so we have to process another 250. Credit revenue, 250. The contract says that we're allowed to invoice another 30%, so we debit debtor, 150 credit, contract asset,
That's it.
150. Now what happens?
You have
Okay, so what was our balance on the contract asset at the end of year one? 50. Okay, 50 credits. And now what happens in year two? We have a debit of 250 and a credit of 150. So what is your balance at the end of year two?
It's a 50
50 credits.
isn't it a debit because by year two contract is credit from in 200 minus 150.
Okay, let me just draw it here at the bottom for you. All right, so the opening balance from last year was a 50 credit. Okay, this year with the first journal entry was a debit to contract assets, so we debit
250. $150.
150. Okay, so overall, at the end of the year, the closing is a 50 debit.
Yes.
Okay, now why is it in debit? Can you see that we've done 70% of the work, but they've only allowed us to invoice for 60%. So there's 10% of the work that I've done that I haven't invoiced for. So you still owe me for that work, even though legally it's not a debtor in terms of the contract, you still owe me. So 10% of that work is 50 million. Here's our closing 50 million debt.
Yeah.
Comfortable?
Yeah. Yes.
Okay, cool. Let's go back to our stuff. Where were we now? Okay, yeah, so I was asking any other questions on this before we go on, guys?
Yeah, Manuel, I just have a quick one. So do you know how they return to? So we put it back into stock, right? We put it back into inventory.
Yes.
So if they return to because it was damaged, obviously you can't put that into inventory, you have to impair it. So would you still debit inventory and then later impair?
Correct, yeah. So they would have to give you more information to get you an NRV of that stuff.
Okay.
So you have to bring it in at cost and then do a separate impairment assessment.
Okay, so you'd still bring it in as normal, even if it was damaged,
100%.
and then later impair.
Yeah.
Okay. All right.
Okay. Any other questions, guys, before we move on? Okay. Last part of the question. Stop share. Okay. They then ask to provide a memorandum to the management of hoi polloi, all right, to discuss the classification of the joint arrangement. So when they're asking for classification, what are they asking for?
Is it a JO or a JV?
A JV or a JO? Okay. Do we need to go prove that there's joint control in all of those things?
No, they already told you there's joint
No,
control.
100%. They tell you that it is a joint arrangement. So we agree that it is a joint arrangement. The question wants you to focus on, well, what type of joint arrangement is it? Okay, so that's why it specifically says the classification. Okay, let's go have a look here. All right, so we identified an opportunity to assist children in rural areas in the countryside of South Africa by taking dental services to them by means of mobile dental units. The management of hoi polloi approached Openwide, an unrelated entity, to form a consortium to make this reality. A separate entity, Milky Teeth, has been formed. Hoi polloi each have 50% shareholding, and they've signed a consortium agreement, okay, that outlines the activities of the arrangement and establishes a joint arrangement committee. Each company has a representative in the committee, and all decisions require unanimous consent. Okay, so all of these things are things that you would have discussed if they didn't tell you it was a joint arrangement. Okay, but they've told us already it is a joint arrangement, so we don't need to prove that you need unanimous consent, that there's no other major controlling party, and all of those requirements. Okay. Let's take a step back, guys, and let's summarize some of the stuff that we know already about how to classify between JOs and JVs. What makes the difference between a JO and a JV?
In a JO, you are liable for the liabilities, and you have the rights to the assets of the JO, whereas with the JV, you have the right to the net assets.
Okay, all right. And what about being a separate entity, as they mention here?
A separate vehicle, you could be either.
Okay.
A JV
right, so
or a JO.
100%. Okay, so at this point, they've told us it's a separate entity, but we're not still quite sure what the classification is. Okay. Then they tell, okay, so if we go on and we look at some of the other stuff, they tell us we are responsible for manufacturing the dental units, and Openwide will do the supply and fit. All right, so already you can see that there's separate responsibilities. Each company uses its own resources and expertise in order to manufacture and distribute the dental units jointly. All right, the companies share revenues from the mobile dental units and jointly incur expenses. The revenues and common costs are shared as contractually agreed in the consortium agreement. Okay. So again, if you're looking at a situation, guys, where you're trying to figure out, do we have rights or obligations in terms of individual assets and liabilities or individual expenses? If you don't have those rights, then you're looking more at a JV type setup where you're going to equity account. So in other words, if you don't have rights to specific revenues as a shareholder, then means that you're entitled to the net profit. Okay, so the principle there is that you then be looking more at an equity accounting space. Okay, but here they're telling you, all right, that the revenues are going to be shared. Okay, they don't say equally. All right. However, we will jointly incur expenses. Okay. We share the revenues from the sale, but we'll jointly incur expenses, and the revenue and common costs are shared as per the consortium agreement. So it's not in proportion to shareholding. So already that starts giving you an indication at this point in time that we may be actually leading a little bit more to JO type space, because we're not having a 50% of the net profit. There are specific rules and arrangements that we've made on how we're splitting revenues, assets, and liabilities. All right. A separate bank account is established to which the revenues received and the share costs are paid. All right. The bank account is in the name of Milky Teeth, and each company owns separate costs and recognize fully these costs in their separate financial statements. Okay. So can you see each of the entities already? There are identified costs that each one of them have to settle on their own. Okay, so it starts giving you more of an indication that it's not a net asset or net profit benefit that we have. It's a little bit more than that. Okay, these costs include the labor, manufacturing costs, supplies, inventory, unused parts, work in progress, all cool. Hoi Polloi and Open Wide obtain full ownership of the assets used in the management arrangement and are separately liable for the obligations incurred. Okay, what does that mean? So can you see
That they
here
are
already?
liable for.
Yeah. So can you see here, Hoi Polloi, they own and retain the ownership of full assets that they've used in the arrangement. So in other words, Hoi Polloi, if he contributes a vehicle, he still retains the full ownership of that vehicle. So again, is it an indication that these guys are sharing in the equity, the net equity?
No.
No. All right. So based on that, do we conclude with a question like this? Is it J or JV?
A JO.
A JO. All right. So let's go have a look quickly then at the solution. Okay, guys, I know this is only a 4-mark question, but they did ask a memorandum for management. So you're just using a memorandum format would have earned you 1 mark, and that's 25% of this question. So just be aware of that type of thing. Okay. All right. So we pretty much, as specifically stated, it is a joint arrangement. Okay, so we're saying that we know that it is a joint arrangement. It's a separate entity. Now, in my mind, these things shouldn't actually be on the solution. Okay, because they've already told you it is a joint arrangement. You don't need to go prove that it's a separate structured entity. Although I suppose what they're getting at here is that the fact that it is a separate entity means it could be either a JO or JV, which is what they mention here at the bottom. Okay. All right, they're separate financial records, and it can either be classified as a JO or a JV. Okay, so that's the whole purpose of this. They weren't including this in order to have the discussion on whether we have a joint arrangement. We've already been told it's a joint arrangement. So it was to lead up to the discussion on that it could be either a JO or a JV. In terms of the legal form.
Sorry, Manuel.
Yeah.
If we had included these points like they have here, would we lose marks?
I don't know. You wouldn't lose marks. You would just lose time, which is if indirectly going to cost you marks. Yeah.
Okay.
Okay. Features of the contractual arrangement. We say that the parties have rights to the assets and liabilities of the arrangement. We have already covered that. They share the common costs in proportion. The revenue earned is allocated to each party. Okay. And the parties are actually individually liable for the claims of Milky Teeth. So just based on that, you can come to the conclusion that this is actually a joint operation, and that is going to give you another conclusion mark. Okay, so pretty much, guys, this question was out of 4. Again, 8 marks available. So again, no reason as to why we couldn't at least get 3 out of the 8, which then gives you a 3 out of 4, considering one of them was a mark for giving a nice format. So overall, I think this is a really good question as well. Fair, maybe generous on the side of UNISA. I would like you guys to mark yourselves though, and give yourselves an honest mark, because it is a good standard question, and use that as a base for where we need to improve. It is quite an important thing, guys. The revenue is going to be big in test 2. So I really need you guys to brush up on that side. Are there any further questions before we close?
Melly,
Yeah.
yeah, Mel, I have a question for you. When you look at the bullet point where it says the legal form of the separate entity, Milky Teeth, is a private registered in terms of the Companies Act.
Yeah.
So it's just underneath when it says when. Now, underneath that, it says that the assets and liabilities held by Milky Teeth are the company's assets and liabilities, and the shareholders are entitled to the net assets. I don't
Correct.
understand that because that speaks to a JV.
Sure. 100%. Okay, so pretty much what they're saying there is that if you look at the way companies are structured in terms of the Companies Act, a shareholder would be entitled to the net assets naturally. However, in this, so in the case where there wasn't a contractual arrangement, which is what they mention here, if there wasn't a contractual arrangement, you would then say, okay, cool, they're entitled to the net assets. However, what we're saying is that the contractual arrangement overrides the Companies Act in the sense that we can agree outside of the Companies Act how we'd like to split things up. And the contractual arrangement is the one that has all of these points that then leads us to a JO. So from an exam technique, it's a good point or good way to start with this particular point, because it will start off your discussion and it is worth 2 marks. But that's pretty much what they're trying to get you to see, is that because we have the contract in place, the contract has things that is outside of the Companies Act, which we're taking into account.
And that overrides the Companies
And that
Act.
overrides the, I wouldn't say overrides the Companies Act. The Companies Act does allow you to put contracts in place that deal with these types of things. So maybe override is not the right word, but I suppose here in the question they use the term override. But yeah.
Okay. Okay.
Okay. Any other questions, guys? Okay, guys. I just want to check how many of you have done the super mega homework.
I haven't done it yet.
I have.
And the other 10 people who are online?
I've done
No,
that.
I haven't done mine.
Okay. All right, guys. Maybe let's break for lunch. Those of you who haven't done it, I would suggest do it. And what we'll then do is we'll reconvene then at 3 to go through that. It's only part G, so it's only a 19-mark question, so it should take you 30 minutes. But I just want you guys to see the caliber of the type of financial instruments that you could expect, and considering that was last year's board exam, so it's still quite a topical thing. All right, so we will reconvene at 3. What's that?
Is it on the PACER?
It is, yeah.
Question.
When we did financial instruments, it's on the PACER. It was given to you. It's called Super Mega. It was given to you as part of the homework.
Okay. All right.
Okay, so we're only looking at part G. All right, so we'll reconvene at 3 o'clock, guys.
Okay, thank you.
Cheers. See you now.
Bye.
Thanks.